Guys, so I hope you enjoyed that quick introduction about, well, not really quick, it took quite a while, right? But I hope you enjoyed that introduction about what calls and puts are. And again, you may have to review that video a few times before you really get it, because it takes a while initially, but once you get it, it becomes second nature. So here's a quick quiz for you. Ready? Grab a pen or, write it down somewhere, yeah? Okay, so remember, for call options, when you buy a call, you have the right to what? Write your answer down. You have the right to, that's right, buy 100 shares at the strike price. When you sell a call, you're obligated to, opposite, it's always the opposite, right? You're obligated to sell 100 shares at the strike price. So keep repeating this again and again. When you buy a call, you have the right to buy the shares. When you sell a call, you're obligated to sell the shares. Okay? So remember that as the buyer of the option, you always have the right. You always have the right. But as a seller of the option, you're always obligated. Next, put options. So when you buy a put, you have the right to, write down your answer before I give you the answer. When you buy a put, you have the right to sell 100 shares at the strike price. And when you sell a put, opposite, when you sell a put, you are obligated to buy 100 shares at the strike price. So again, option buyers always have the right, option sellers always have the obligation. Here's a good visual summary of calls and puts. So again, calls and puts. When you buy a call, remember, it's a Nike sign, the Nike swoosh logo. Okay, so limited risk, unlimited return. And you buy a call when you are bullish. You buy a call when you expect the share price to go up. Share price goes up, you're happy, it makes money. Okay? When you sell a call, you flip that chart over like that. So when you sell a call, what happens? When you sell a call, you are neutral to bearish. So you're neutral, or you think the price is going to go down. So if the price stays where it is or goes down, you keep that premium, limited reward premium. But if the stock price goes up, the stock price goes to infinity, then you have unlimited risk of loss because you have to buy the call back at a higher price. That is if you sell the call naked. So again, never sell naked. But if you already own the 100 shares and you sell a call, then that's fine. You won't have that downside risk if you own the shares. Then you are covered. This only happens if you sell the call without owning the shares or without hedging yourself with another call. All right? Okay, on my right are puts. So for puts, if you buy a put, that's what the chart looks like. It's kind of like a mirror image of the call, right? It's just a mirror image of the call. So when you buy a put, you are bearish, right? You're bearish. So the more the stock price goes down, the more money you make. And if the stock price goes up, you lose the premium. So again, limited risk, but high profits if the stock goes down. When you buy a put, you have the right to sell the shares at the strike price. Next, if you sell a put, you'll then be flipping that chart over like that. When you sell a put, you are bullish to neutral. You're bullish to neutral. So if the stock price remains where it is or goes up, you get to keep the premium, and the options expire worthless. Okay? But if the stock price goes down, and theoretically if the stock price goes all the way to zero, you could lose a lot of money if you sell a put. That's if you do it naked. But again, if you sell a put on a good company, you know good companies won't go down that much. And if you have the cash to buy the 100 shares, then there isn't that downside risk. Okay? So that basically summarizes calls and puts. Okay. So right now, let's talk about intrinsic value. I've talked quite a bit about it initially, but let's really nail down what it means. Intrinsic value of call options first. So If you go to the option chain, which I'll show you in a while, you can see there are many strike prices. And again, you could choose or buy whichever strike price you wanted. Okay, so these are the strike prices of Microsoft call options. So let's imagine that Microsoft is now trading at 220. If you were to buy this call option, what would it mean? If you buy the 210 call, it means that you have the right to buy Microsoft shares at 210 and sell it in the market for 220, giving you a profit of $10. So which means this particular option at 210 strike price has a potential profit of $10 locked into it. We call that the intrinsic value. So this option has an intrinsic value of $10, and we say that this option is in the money. In the money. How about this option? So this option has a strike of 215, which again means that you have the right to buy the shares at 215, and you could sell it to the market at 220. So this option again has an intrinsic value of $5. Correct? 220 minus 215 is $5. This option is in the money as well. So notice that the intrinsic value of any call option is the stop price minus the strike price. So the stop price minus the strike price is the intrinsic value. Now, how about this particular option here? The strike price is the same as the market price. So we say that it is at the money. So whenever we say an option is at the money, it means that its strike price is at the market price. When we say an option is in the money, or rather when we say a call option is in the money, it means that the strike price is below the stop price. Hence, that's an intrinsic value. So you can see that this at the money option has no intrinsic value because you have the right to buy the shares at 220 and sell it to the market at 220. You don't make anything, right? So there's no intrinsic value. But does it mean that this option is worthless? You can buy it for free? No, it's worth something. It's still worth something. It's worth what we call hope value. H-O-P-E, hope value. Why? Because there's a hope that Microsoft shares could go up in the next few days. And if Microsoft shares do go up, then this option would then be in the money. So there's a hope it could happen. So this option has hope value, and we call this hope value extrinsic value. Write this down, extrinsic value. And extrinsic value is very much made up of how much time there is left to expiration. So if this option expires in, say, 60 days, there's still a lot of hope left, and this option could be worth quite a bit. Okay. Now this option over here, 225, it is out of the money. It is out of the money. Why is it out of the money? Because you have the right to buy the shares at 225, but right now the shares are 220. So it's kind of like out of the money. So again, there's no intrinsic value. This one also has no intrinsic value, but it's still worth something. Again, what is it worth? It is worth the extrinsic value. Why? Because there's a hope that Microsoft could still go up in the next few days, and these options could become in the money. So as long as there's time left, there is extrinsic value in this option. Let's take a look at the option chain right now. Okay, so I'm using the Think or Swim TD Ameritrade trading platform. Now you can use any broker that has options, but choose a good regulated broker like Think or Swim, TD Ameritrade, Interactive Brokers, and you'll be pretty similar, okay? So I'm now looking at Microsoft, and this is the option chain. So you can see the first thing on the option chain would be all the different expiry dates. We call it DTE. DTE stands for Date-To-Expiration. So you can see this next, the first option expires on the 15th of January, which is today. So there's 0 days left to expiration. And going down the list, you can see that this option expires on the 26th of February. So there are 42 days left to expiration, and so on and so forth. So you could buy an option with 28 days left to expiration, 35 days, 42 days, 182 days, 371 days, 400 days, even 500 days. So you could even buy an option that expires in 2 years. Okay, so you can choose whichever option that you want. Now, you also notice that you have got these options in purple called weekly options, which means they expire at the end of the week, at the end of, they expire on the Friday of every week, of any particular week, sorry, right? And those options that you see that are in black, they expire on the third Friday of the month. They're called monthly options. Now, you don't have to worry about weekly options or monthly options, right? It doesn't matter, what really matters is that you choose the date to expiration that suits your strategy, and we'll talk more about that later when we talk about specific strategies. But for now, I just want you to know that yes, you can choose options at many different time frames, different expiration dates. So let's open up the one with the expiration date on the 19th of February, and that expires in 35 days. So let me open that up. Boom. Okay. Now over here, I can select the number of strikes. These are the strike prices. I could select 50 strikes, 30 strikes, whatever. All right. Okay. Let's just select 30 first. Now, on the left, these are all the call options. And on the right, these are all the put options. So let's look at the call options first, and at the center you see these are all the different strike prices that I could choose. Okay. So currently Microsoft is at 213. This is the last trading price. Right now the market's closed, so that's the last price. Okay. So let's take a look at this strike price over here. Again, 213. That's the current stock price. So if I choose the option with a strike price of 210, let's choose this one. Let me ask you a question. This option, is it in the money or is it out of the money? You tell me, in the money or out of the money? That's right, it is in the money. Why is it in the money? Because the strike price is below the stock price. So this option is in the money. Now, in the money is in yellow. The one in white would be out of the money. So if you look at this option, what is the premium that you have to pay to buy this option? Again, if you buy the option, you have to pay the premium. If you sell the option, you collect the premium. You can either be a buyer or seller, right? So you can see that if you want to buy the option, you have to pay a premium of $9.75. That's the ask price. So you always buy at the ask price. I repeat, you always buy at the ask price. And if you want to sell this option, you sell it at the bid price. So if you sell this option, you will collect $9.45. If you buy the option, you will pay $9.75. So there's a bit of a difference. So you can also take the midpoint, or we call it the mark. Mark would be the midpoint between the two, which would be about $9.60, which is about the center of this two. So you can take this as roughly the rough market price of this option. Okay. So question, this option that you see, what is the intrinsic value? Can you tell me what is the intrinsic value of this option? This Microsoft 210 option. What is the intrinsic value? Intrinsic value is always, remember, stock price minus strike price. Right? So the stock price is now at roughly 213. And the strike price is 210. So the intrinsic value is $3. but it's selling for 960. So it's selling more than the intrinsic value. Why? Because remember, there's the extrinsic value. So the difference between the price of the option, the premium, and the intrinsic value would be the extrinsic value. So in this case, you can see the extrinsic value would be 960 minus $3 would be $6.60. Okay, so more on extrinsic value later on. Got it so far? Okay. Now, if you look at the 205 strike, that will be even more in the money. So notice that as we go down, it gets more and more in the money. As it gets more and more in the money, what happens to the price of the option? Notice the option price is $9.60. Now this option is $12.70, $16, $20, $24. So notice that the more in the money the option is, the more expensive it becomes. Because it is more in the money, there's more intrinsic value. Got it? Now, if we look at the 215 option, 215 would be out of the money. Out of the money, right? So the Microsoft 215 option is out of the money. Can you tell me what is the intrinsic value of this option? The intrinsic value is 0. That's right, because out of the money, there's no intrinsic value. But this option, 215, is selling at $7, $7.05, which means the extrinsic value is $7.05. So options out of the money have no intrinsic value. Only options in the money have an intrinsic value. And again, notice that as we go more out of the money, like 215, 220, 225, what happens? The option gets cheaper, right? $7, $4, $3, and gets really, really cheap. It gets really, really cheap. One question people ask would be, okay, so which strike price do I choose? There's so many strike prices. The answer is it depends on the strategy. So in the subsequent lessons, depending on the strategy, we choose different strike prices. And we'll go through that later on, so hold on to your horses. The other question people will ask would be, okay, what date to expiration do I choose? 30 days, 60 days, 1 year? Again, it depends on the strategy. More on that later on. But what I also want to show you is that the further the date to expiration, the more expensive the option is. So for example, if you choose this option that expires in 7 days, and for example, if you choose the strike price of, say, 215 strike price, you can see you can buy this 215 strike price at $2.43. Only $2.43 for this 215 strike price, because there's only 7 days left, right? But if you choose 35 days left, there's a lot more time left, that same 215 strike would now cost you $7. So again, when you choose a longer time to expiration, you've got more time to be right, but it's going to cost you a lot more money. And the share price has to move a lot more for you to break even for those really long dated options. Okay, so for put options, it's the same, except that it's the opposite. For put options, the intrinsic value would be the opposite. It'll be the strike price minus the stop price. So the lower the stop price, the bigger the intrinsic value. So again, if you take a look, these are the strike prices of Facebook, for example. And say Facebook is now trading at 150. So if you look at this option, with a strike of 160, it means you have the right to sell Facebook shares at 160. But currently it's at 150. So you could buy at 150, sell it at 160, and you could make money immediately. So this has an intrinsic value of $10. Right? So strike price minus stop price gives you intrinsic value. That's in the money. This one is in the money as well, with the intrinsic value at $5. And now you tell me, this strike price at 150 is the same as the market price. That is called what the money? That's right, at the money. And at the money, there's no intrinsic value as well. How about 145 strike? That's right, out of the money, out of the money. So again, these options out of the money have no intrinsic value, but they have extrinsic value, the hope value. And again, the longer the time to expiration, the more hope there is, the more valuable this is, because there's still a hope that Facebook could go down and these options could eventually be in the money at expiration. So again, let's look at the option chain. We could look at a different stock, for example, Bank of America, BAC, and you can see right now, market's still closed, but the market's going to open at about $34. So you can take the market price as, $34. And again, you can see all the different dates to expiration. Let's choose the 28 day to expiration. Let's open that up. Expiring 12th of February. And on my right are the put options. So again, if you choose this put option at $34.50, it is in the money or out of the money. In or out, guys. In or out. That's right. It is in the money. All right. Yellow is always in the money. White is always out of the money. So why is this in the money? Because it is above the current price. So for puts, when the strike price is above the current price, it is in the money. And could you tell me the intrinsic value of this option? Okay, the Bank of America, 34.5 put. What's the intrinsic value? It'll be the strike price, 34.50, minus the stock price, 34.05. So roughly, what's that? Uh, 45 cents, right? So the intrinsic value is 45 cents. But it's currently selling at the market price of $1.61. Can you see? Mark, M-A-R-K, that's the market price, which is the mid of the bid and the ask. So what is the extrinsic value? It'll be 1.615 minus 45 cents. So the extrinsic value or the hope value would be 1.165. Okay. Now again, if you take the 34 strike, it's in or out of the money, guys. In or out of the money. It's out of the money, right? So there's no intrinsic value. For the Bank of America 34 put, the intrinsic value is 0. But it's still worth 131. So the extrinsic value has to be 131. There you go. Okay. So in summary, the premium of the option, again, premium is the same as the price. So again, when you buy an option, you pay the premium. When you sell the option, you collect the premium. And this premium is made up of intrinsic value and extrinsic value. Intrinsic value is the part of the option that is in the money. So for call options, the intrinsic value is equal to the stock price minus the strike price. So the higher the stock price goes, the more intrinsic value the call has, and the call becomes more valuable. For put options, the intrinsic value is the opposite, strike price minus stock price. And the lower the stock price goes, the more intrinsic value the put option has, and the lower the stock price goes, the more expensive that put becomes, or the higher the premium gets. And then you've got the extrinsic value, which I just showed you on the chain. Okay, so extrinsic value is also known as, like I keep saying, hope value. How much hope is there left? And extrinsic value is made up of two components. So what determines how much hope there is made up of, number one, the time value of the option. How much time is there to expiration? So the more time there is to expiration, the more extrinsic value. Obviously, if the option has 100 days to expiration, then it's worth a lot more than the option with only 7 days left. Okay. The other part of extrinsic value comes from what we call volatility premium or implied volatility. So what does it mean? So if the stock happens to be a very volatile stock, right? It goes like, oh, very volatile stock. What happens? Then the options will be worth a lot more. Because if the stock is very volatile, it goes up and down a lot, then there's a very good chance the stock could jump up very high and the options that were out of the money become in the money. Or there's a chance the stock could drop a lot and the put options that were out of the money can be in the money. So there's a lot of hope when the price moves a lot. So if the stock is very volatile, the options are worth more because there's more volatility premium in the options. But certain stocks have low volatility. So if the stock moves like that, okay, and the stock, for example, is always at $100, it's like 101, 102, 99, right? It's very low volatility. Then the options are going to be worth less because there's not much hope that the stock is going to go up or go down very much. All right, so it's time to formally introduce the Greeks to you. So the Greeks are all the things that affects an option's premium or price. So again, when we are buying an option, we want to ensure that the price of the option goes up. When we're selling an option, we want the price to go down. But what affects the price? And basically, there are 5 things that affect the price. Number 1 is delta. Number 2 is gamma. Number 3 is Vega. Number 4 is theta. And the last one is rho. We won't be looking too much at rho because rho measures the change in the option price due to a 1% change in the interest rate. And that normally affects only very long-term options that we are not going to really be focusing on. So no worries about rho, we'll be focusing more on the first 4, delta, gamma, Vega, and theta. So let's go to the first one, which is theta. So when you think of theta, think of T, which is time. So we'll be talking about time value and expiration. Now again, when we buy options, we can buy options with different times to expiration. It's really up to us. And of course, the longer the time to expiration, the more time value, the more expensive the option is. So again, you can buy options with time to expiration as long as 3 years, as short as 1 day. As I mentioned, the further the expiration date, the more time value, the higher the premium that you pay. What happens is once the option reaches the expiration date, there's no more time value. Time value becomes 0 and the option price is equal to the intrinsic value. So if the option is in the money, there's an intrinsic value. If the option is at the money or out of the money, there's no intrinsic value and the option is completely worthless. So look at this chart over here and you can see that as time goes by, the option loses time value. So it's known as a decaying or wasting asset. It loses time value till eventually the time value goes to 0. And time value tends to decay the fastest in the last 30 days. It declines exponentially. So as traders of options, we want to sell our options, right, 30 days before expiration. So in other words, we buy an option and we want to sell it at a higher price. So in general, we always like to sell it when there's still some time value left, when there's 30 days to expiration, because 30 days to expiration, the time value tends to decrease exponentially. And if we hold on to the option, what's happening is that we're losing a lot of value in the option. So we want to, again, sell it as high price as possible. So we want to sell it before we lose that time value. But there are exceptions to the rule. If the option is really deeply in the money and we want to hold it a bit more to expiration, there's nothing wrong with that as well. But if we're not really deeply in the money, then it may be a good idea to sell 30 days before expiration. Now, when do options expire? Most of the time, we trade monthly options. Now, there are also weekly options, but for most part, again, we trade monthly options and they always expire on the 3rd Friday of the month. So again, recall when you look at the option chain, which you saw a while ago, there was a column called theta. So theta is the rate of decay of an option. So when you see a theta of minus 0.05, that means 5 cents loss a day, which means every day that passes, the option loses 5 cents, including weekends as well. And again, as the option nears the expiry date, you could go up from 5 cents to 6 cents to 7 cents. It increases as you near expiration till the whole thing goes to zero. So again, all options have fixed expiration dates. There are weekly options, but they tend to be less liquid with less transactional volume. They tend to expire on the Friday of every week. Like I mentioned, we tend to prefer to trade monthly options with more liquidity, with more volume, and they expire on the third Friday of the month. So when options are more liquid, when there's more transaction, the bid-ask spread tends to be tighter. So we can buy and sell without that much slippage in the markets, right? Now, there are also quarterly options that expire every quarter, and these quarterly options expire on the last day of the quarterly month, like January, March, June, and September. And finally, you have LEAP options. LEAP stands for long-term anticipation securities. And LEAP options are options that expire many years in the future, for example, 3 years in the future, and they tend to expire on the third Friday of January. So that's what you need to know about time value and theta. Now, as an options trader, the next thing that we really have to pay attention to is the volatility of the stock and the market, because volatility makes up a huge part of the extrinsic value of an option. And many amateurs, they fail to look at volatility, and so they find themselves not profiting as well. So as professionals, we focus very much on volatility before we buy or sell an option. Now, in general, the higher the volatility of a stock, the more expensive the options are. So when does volatility increase? So there are times when volatility is really low, and there are times when it's really high. It tends to get high during news events. For example, when a stock is going to announce earnings, its volatility increases tremendously. Or when there's some kind of news event like the FOMC, which is the time when they announce interest rate increases or reductions. So times like that, volatility increases. If you're trading oil, whenever there's an OPEC meeting, volatility increases as well. So always remember the golden rule. We only buy options when volatility is low. Because when volatility is low, option prices are low. And you always want to buy when they're low, when they're cheap, right? You want to buy low and sell high. Okay? And you only want to sell options when volatility is high. Because again, when volatility is high, options become expensive. Premiums are high. That's where you want to sell. Because you want to sell high and eventually buy back low. Now, in the basics option course, we're going to focus more on buying options. In the advanced course, we focusing more on option selling strategies. So for the purpose of the basic course, we want volatility to be low before buying call options or put options. Got it? All right. So question people ask would be, how do you measure volatility of the stock or of the market, or of oil prices, or of the euro, for example? Well, we look at a very important measure known as implied volatility, known as IV. So from now on in this course, when we mention that IV is high, it means high volatility. IV is low, low volatility. So again, when do we buy options? When IV is low. Very good. When IV is high, never buy options because you can't make money. Similarly, when IV is high, you want to sell options. So first of all, what does IV mean? What is implied volatility? Well, implied volatility shows us where the market views the volatility of the stock in the future. And option prices always price in future expectations. Okay? Implied volatility basically implies the magnitude of the underlying stock price move within a year, with a 1 standard deviation probability. Yeah, what the heck does that mean? Okay, let me break it down for you. All right. So basically, let's imagine there's a stock which is selling at $50. For example, again, Coca-Cola, and the stock has an implied volatility of 20%. So what does it mean by an implied volatility of 20%? Well, it means that the market expects the stock to move up by 20% or move down by 20% within a year, within a 68% probability. And that's what it means by one standard deviation. One standard deviation means a 68% probability of it happening. All right. And so how is this 20% measured? Well, it's measured using an options pricing model known as a Black-Scholes formula. So don't worry about all that. Let's leave that to the mathematicians. All we care about is what's the IV right now. So how can you find the IV? Again, when you go to your Think or Swim platform or whatever platform you're using, you can check the IV. So for example, under option statistics, you can see for this stock, the current implied volatility is 32%. Okay, so is that high or low? Well, we have to measure it based on the stock's 1 year history to say, okay, based on its 1 year history, what's the rank? Is it, high or low? So what we are more interested in is to look at the implied volatility percentile. So this is what we are looking for. And it's shown in terms of a percentage. So in this case, it's 46%. So in general, we want to buy options only when the IV percentile is below 40%. That tells us that options are cheap right now. And we want to sell options ideally when the current IV percentile is above 50%. But again, we'll focus more on that in the advanced options course. Are we okay so far? All right. If you have to review this video, do it as many times as you can before you get it. But again, for now, remember, we're just interested really in the current IV percentile. For it to be below 40% to buy options ideally. Now, let me introduce you to the next Greek. So we've learned about theta. The next Greek has to do with volatility. It's known as Vega. So Vega is V. V is for volatility. So Vega measures how much the option premium will change due to a 1% move in the implied volatility. So how sensitive is the option to implied volatility? So let's imagine there's an option with a premium of 150, selling at a 150 premium, and its Vega, it's 10 cents. So what does it mean? It means for every 1% move, if implied volatility moves from 20% to 21%, which is a 1% move, the option premium will increase by 10 cents from 150 to 160. Now, in general, the further we are from expiration, the higher the Vega. So when you buy options with long expiration dates, you've got higher Vega. Shorter expiration dates, you've got lower Vega. The next thing is delta. So delta is really important because delta measures the change in the option price or premium relative to the change in the underlying stock price. So again, delta tells us for every $1 move in the stock price, how much does my option price move? So if you see a delta of 0.8, what does it mean? It means that for every $1 increase in the stock price, the option price will increase by, there you go, 80 cents. Okay, now this is also known as 80 deltas. Okay, so notice that for calls, delta is always positive. Why? Because when stock price goes up, calls go up. So it's in the same direction, it's positive. But for puts, delta is always negative because put prices go opposite of the stock price. Stock price goes up by $1, puts go down by a certain amount. All right. So in general, notice that whenever a call option is at the money, the delta is always 0.5, always, or 50 deltas. Which means when you buy an option at the money, if the stock price goes up by $1, your call option will go up by 50 cents, half. Okay. And options that are out of the money will have deltas of less than 0.5. So for every $1 increase in the share price, deltas, the option price will move less than 50 cents. And in the money, call options have a delta of between 0.5 to a maximum of 1 delta. So when the call option is very deep in the money, deltas increase to a maximum of 1. So 1 means the option behaves like the stock. The stock goes up by $1, the option call will go up by $1. So the same thing for puts, right? So at the money puts, delta is always minus 0.5. Out of the money puts, delta is always less than minus 0.5. In the money puts, delta is always anywhere from 0.5 to 1 negative. So if the put has a delta of minus 1, all right, by the way, in reality, you never have a delta of 1 or minus 1. It's 0.99 or minus 0.99, right? So again, if you see a delta of minus 0.99 in a put option, it means that for every $1 decrease in the stock price, the put option will increase by 99 cents, which is again almost 1 for 1. The other interesting thing to note is that delta also tells us the probability that the option will expire in the money at expiration. So in other words, when you see a delta of 0.5, it also means that there's a 50% chance the option will expire in the money at expiration. And again, if it's 0.6 in the money, it means 60% chance the option will expire in the money at expiration. So a common question people ask would be, okay, so what's the best strike price to choose? What's the best delta to go for? Now, there's no holy grail answer. It really depends on your strategy. Some traders who are more aggressive, they prefer to buy options that are at the money or one strike out of the money. Now, when you buy options that are out of the money, they are cheaper. So that's a good thing about it. But there's a lower probability that it will expire in the money. Your chances of winning are lower. So you have to be confident in a very strong move in a stock price to buy options that are at the money or out of the money. Traders who are a bit more conservative would buy options which are deeper in the money. When it's deeper in the money, your delta is higher. So when the stock price moves, your option moves faster. And there's a higher probability that you expire in the money. So that's the good thing about buying in the money, but they tend to be a bit more expensive. So again, there are pros and cons, and we'll look more into that into detail under the strategy section. Alrighty, let's look at the last grid, which is gamma. So remember that as the stock or the option gets more in the money, the delta is higher. As the stock price moves, the delta changes as well. So how much does the delta change? Well, this is measured by gamma. So gamma measures the change in delta due to a $1 move in the underlying stock price. So gamma is known as the delta of delta, right? So if you think of delta like speed or velocity, gamma is kind of like acceleration. How fast does delta move with the stock price moving by $1? Okay, so we like to have high deltas and high gammas. And gamma is the highest when the option is at the money, as you can see from the chart, and tends to decrease as it goes out of the money or in the money. And gamma tends to increase the closer we get to expiration date. So as the option is expiring, theta is decaying, so not really good as an option buyer, but what's good is that gamma increases as well. That will increase the delta as the price moves in our favor. All right? So basically that's how we read the Greeks. Now another column you may notice in the option chain is known as open interest. So what does it mean? Well, open interest tells us the total number of option contracts that are currently open and have not been closed yet. So they're currently active. So these are contracts that have been traded but not have yet been closed, exercised, or assigned. And open interest does not change throughout the day. It only adjusts itself at the end of the day for the next trading day. So how do you read open interest? Well, now remember that if you want to buy an option, like you want to buy a call or put, you have to first buy to open and you sell to close it, right? So you buy low, sell high, hopefully, and you make money. Or you can also make money by selling first. So you sell to open and then you buy to close. So again, if you're selling, you ideally want to sell at a high price, sell to open at a high price, and buy to close at a lower price. So in both circumstances, you're opening a trade and closing a trade, right? So whenever you buy to open, or whenever someone in the market buys to open, it creates a +1 in open interest. So open interest is +1. That means one contract has been opened. And if you sell to close the contract, or someone sells to close your contract, it's -1. So open interest becomes 0. Similarly, if you sell to open a call or put option, open interest becomes +1. And if you later buy to close the option, or someone buys to close it for you, it becomes a -1. So it keeps changing all the time. And over here, you can see the total open interest for each of the different options at a different strike prices. So why is this important to us? Well, basically, we like to trade options with a lot of open interest. The more open interest there are means the more active that option is. And the more active it is, notice the bid and ask, the spread between the bid and ask tends to be tighter. When you see an option with the bid and ask very far away, those are not good ones to trade. You want the ones where the bid and ask are close together, all right? And again, as we go into the strategy section, you'll be seeing that we normally trade options with very tight bid and ask spreads with relatively high open interest. If you see options with 0 open interest, that means there's no one trading it. Don't trade those options. Got it? All right. So again, if you take a look at the Think or Swim charting platform, if I were to key in a stock, like again, if I could key in whatever Citigroup, so you could see that again we have got our option chain, and if I click on this, you can see today's option statistics. So this is what I'm interested in over here, and you can see that for Citigroup, what is the implied volatility? It is 38.92%, but like I said, the most important thing is to look at the current IV percentile, which is, my God, is 100%, right? So what did I say? I said that we only want to buy options when the current IV percentile is ideally below 40%. So this is way too high to buy options on Citigroup. And if you buy options on Citigroup, they are really expensive. The premium is really, really high, and it's really hard to make money. And one reason is because recently there's been a big plunge in the S&P 500 index, creating a lot of uncertainty and fear, and kind of like hurricane season, high volatility, so the IV percentile is really high. But again, if your strategy is to sell options and collect premium, then it may be a good time to sell covered calls, for example, with a high IV percentile. Now over here, you can see also on the option chain, you can select the layout where you look at Delta, Gamma, Theta, and Vega, or you can also look at the open interest over here, right? So that's the open interest, and you'll be learning about that as well, right? You can see that there are certain options with 0 open interest, which means that no one is trading those options. So you do not want to buy options with the strike price with no open interest as well. So now that you've learned the basics of calls and puts, you will then learn how to put them together in various combinations. Sometimes it could be one call and one put, or 2 calls and a put, or 2 calls and 2 puts into various combinations in order to create strategies that allow you to profit under any market condition with any asset. So think of calls and puts like the atoms. And you know that if you combine atoms into different combinations, you can create new molecules, new compounds that can create literally anything in the universe. So now you are kind of like the god of the markets with these things. So in the level 1 course, Iron Shell, and level 2 Iron Striker, we'll be covering a total of 16 powerful option strategies that, again, you can use to profit under different market conditions. So for example, if you find that the market or the stock is moderately bullish, like it's going up but very slowly, what can you use? You can use strategies like the bull put spread. You can use a strategy like the bull put spread extreme or cash secured puts. By the way, my favorite strategy of all would be the bull put spread extreme. That is what gives me a 90% win rate, and is one of my bread and butter strategies that generates me most of my profits every single month. And this will be covered more in level 2, the iron striker course. But in iron shell, we'll also cover cash secured puts, which is also one of my very, very widely used strategies. Now, if you're very bullish, you think, okay, the market's gonna fly, then you use things like the bullish synthetic strategy, which is also known as the bull bang strategy. You can use a bull call spread or a callback ratio. Now, you know that all these terms mean nothing to you right now. So what the heck does this mean? So again, these are all different molecules, and you will learn in the lessons to come how to combine these two atoms to create all these molecules. For example, what's a bull call spread? Bull call spread is you buy a call and you sell a call at a higher strike price. That's a bull call spread. All right. What's a bull put spread? A bull put spread is when you sell a put and you buy another put at a lower strike price. So you can see different combinations that create different risk to reward scenarios. Now, but what if the market goes on a downtrend? It's bearish, going down. Okay, but you're moderately bearish. Like, may go down, may not go down, I'm not sure. So you're gonna make money whether it goes down or goes sideways. Use a bear call spread. Right? Bear call spread is one where you sell a call and buy a call at a higher price. It's called a bear call spread. If you're very bearish, you think the market's gonna collapse, you use a bearish synthetic strategy, which is basically you buy a put and you sell a call at the same time at the same strike price. That's a bearish synthetic strategy. Or you use a bear put spread, where you buy a put and you sell another put at a lower strike price. Or use a put back ratio. Okay? And what if it goes sideways? Like, you know, it's going sideways, but I want to make money as it goes sideways. You sell covered calls, or you use diagonal spreads. Or you can also use calendar spreads, snipebacks, one of my favorites as well, and the iron condor. And snipebacks also has over 90% winning rate for that strategy. And how about special events like, you know, Brexit or the US elections? You know, volatility is going to increase. How you make money from volatility? You use the earnings sniper spread or the earnings probability spread. So you can see you've got a strategy for any situation. And the best thing is this: you can trade options on stocks, options on ETFs, options on indexes like the S&P 500 index, the Dow Jones index. You can trade options on futures, like commodity futures, like trade options on oil, gold, natural gas, copper. You can also trade options on currency, on currency futures, like trade options on the pound, on the Australian dollar, on the euro. So it's going to be really exciting learning all these things in level 1 and in level 2. So here's a table to summarize the different type of securities that we can trade options on, and we will cover this in time. Now, as you know, Bang and me, we have different preferred ways of trading options, and there's no right or wrong. We're gonna teach you both, and that's why, you know, I'm gonna teach you some, Bang's gonna teach you some, and you know, some of them you prefer his style, some of them you prefer my style, but they both work. Okay, so the first thing you can do would be to trade options on equities, or as widely known, stocks and ETFs. So usually when we trade options, we like to trade options on good companies, fundamentally good companies. So those of you who have taken my value momentum investing course and you know how to select fundamentally strong businesses that are having consistent profits and sales, these are the safest to trade options on. And these are normally large cap companies. So for example, companies like Apple. So we trade options on Apple, options on Facebook, Walmart, Coca-Cola. You can also trade options on ETFs, like the SPY, which is the S&P 500 ETF, or the Dow Jones ETF. Now, for me, I would say that, yeah, about 95% of all my trades are based on equities. That's my preference. So when you trade options on stocks and ETFs, what are the pros? Well, the pros is relatively you can trade with a smaller contract size. And what I like about it is that I understand the companies. Like, I know Facebook really well. I know Apple really well because I've studied the company fundamentals. So when I know the fundamentals, I know that, hey, it's going to go up, all right, even though it may go down in the short term. So I've got a lot of confidence in trading options on companies that I know really well. So those are the pros. Now, what are the cons? What are the cons of equities? The cons is that equity options or stock options, they are American style. Now, what does it mean? Basically, you have got American style options and European style options. American style means that the buyer of the option has the right to exercise the option anytime, before or on the expiration date. So sometimes there could be a bit of a risk if you sell an option, like you sell a call or put. The buyer may exercise it before the expiration. Now, it's not really a risk, it's just a bit troublesome because you have to unwind the trade, which you're going to learn how to do it in the future. And at the same time, it is also very, very, very rare for the buyer of the option to exercise the option way ahead of the expiration date. Like I told you, 95% of the time, I sell call options, I sell put options on stocks, and never in my life has the buyer ever exercised the option before the expiration date. But theoretically, it could happen because it's American style. But like I said, it's really rare. It happens very, very rare. I've never experienced it before, even though I've been trading options for 15 years. So that's how rare it is, okay? The other con is that when you trade options on specific stocks, there could be earnings or news risk, which means, for example, you buy a call option on Apple, for example, and you think that it's going to go up, and then Apple announces bad earnings, and the stock drops because of the bad earnings or bad news, and your trade loses, right? So there's a bit of a risk because of the news or the earnings that could be announced. But then again, remember, when you buy an option, the most you can lose is the premium that you pay. So the risk is capped. So that's the other con about equity options. Now, what strategies can we trade on equity options? Well, all the strategies, okay? Every single one of the strategies. So that's the first one. Next, you can also trade options on indexes. Now, what are indexes? Like the S&P 500 index, SPX, the NASDAQ index, NDX, and the Russell 2000 index, RUT, or Russell, yeah, the Russell. Okay, now, as you guys know, you can't buy the index. You can't buy shares in the index because the index is not a product, right, that you can buy shares in, but you can trade options on the index. So if you think the S&P 500 index is going up, you can buy a call option. If you think it's going down, you can buy a put option. And so what are the pros of trading on the index itself and not specific companies? Well, the pros would be that index options are generally European style. So what's European style? European style means that the buyer of the option can only exercise the option on the day of expiration, but not before that. So the good thing about that is that if you were to sell a call or sell a put, there's no possibility of the buyer exercising the option early before the expiration day. So that's the pro. And there's no earnings risk. There's no risk of the company announcing earnings because you're buying the entire index of many, many companies. But the downside would be generally these options require a higher or bigger contract size, which means that each time you enter, the risk will be bigger, but the reward will be bigger as well. So generally, you need a relatively bigger account. Like for example, I would say at least $50,000 account to trade index options. At least $50,000 to $100,000 account, which I know not many people have, right? So unless you've got a big account, then this is something that you may not want to trade that much. You want to trade more of this where you can trade with as little as a few $100s per contract size. So even with a $3,000 account or $2,000 account, you could trade this really easily. Now, having said that, Bang Pham Van, who I always keep saying is an options genius, he has created a couple of unique strategies like SnipeX and SnipeX 4B. And this strategy has a 90% win rate, and it allows you to trade on the S&P index with relatively low capital, where it's as little as $100 per contract. So it is possible with Bang's unique strategy. Okay. We can also trade strategies like Iron Condor, and we can also use hedging strategies on the indexes. Now, actually, you can trade all strategies on the index. You can trade all of them, but between Bang and myself, our preference is in trading using the strategy called the Iron Condor, which you're going to learn in level 2, and SnipeX, which is also in level 2. Okay, next. The next thing would be to trade options on index futures. Now you say, what's the difference between index and futures? Okay. Now, the difference is that when you trade on stocks and indexes, you can only trade during the market open hours, which would be, when does the market open? It opens at 9:30 a.m. Eastern Time, which is New York time. So you can only trade from 9:30 a.m. Eastern Time to 4 p.m. Eastern Time. But when you trade options on futures, index futures, it is 23 hours a day. That's right. So sometimes I will trade on index futures because I want to get in before the market opens. So I trade the futures. And there are basically two which I trade once in a while. The S&P E-mini futures, ticker symbol /ES, and the S&P Micro E-mini futures, ticker symbol /MES. Now, bear in mind, whenever you trade futures, there's always a slash. Okay, slash, or is it called a backslash? Yeah, backslash ES or backslash MES. Again, what would be the pros? European style. Again, indexes are always European style. Unless you trade the quarterly expiry date, then it would be American style. But if you trade the normal monthly expiry or the weekly expiry, then it's European style. All right. Again, no earnings and 23 hours a day. So you could get in a lot earlier before your friends get in. But again, the cons would be higher contract size usually. But this one, the Micro E-mini futures, this one is pretty small. Yeah, it's this one with a bigger contract size. This one's pretty small. I'll show you examples in a short while. Now, again, you could trade any strategy on these futures, anything. But my preference is to trade normally the debit spreads, like the bear put spread and the bull call spread. And I normally use this when I am hedging my portfolio. Okay. Now, the next thing would be to trade options on commodity futures and commodity and currency futures. Now, this is something that I don't do at all. Okay, it's not my thing, but Bang loves it, right? Bang does a lot of currency and commodity, but I kind of stay away from it. So that's more of his area, okay? So example would be, what are commodity futures? Oil. So oil, ticker symbol /CL. You could trade options on oil, options on gold /GC, options on natural gas gas/NG. You could also trade options on currency futures. The only time I did it was during Brexit, when I was betting that a pound would rebound. I traded on the options on the currency futures. So example, the euro would be /6E, the Australian dollar /6A. Okay, so again, good thing about this would be European style, no earnings, but higher contract size. Again, you could trade any strategy, but for Bang, he tends to focus on iron condor for futures. But you could trade other stuff as well if you want to. Lastly, you could trade options on volatility. So for example, when volatility is low and you think that volatility is going to go up, you could buy call options on the volatility index. And normally I do this as a way to hedge my portfolio as well. Again, we'll learn this more in the lessons to come, right? And we tend to focus on the VIX. The VIX is the volatility index. So we can trade options on the VIX futures. Yep, VIX futures, right? Sounds a bit complicated now, but it's actually really simple once you learn all this stuff, okay? And then you can tell your friends, I'm a professional trader. Okay, so again, European style, no earnings, higher contract size, and between Bang and myself, we love trading on volatility. We love it. We make a lot of money from it, and we tend to use the back ratio strategy and the bull call spread. So bull call spread you learn in level 1, and back ratio you learn in level 2. Okay, so that's an overview of all the stuff that we can trade options on. Now, earlier on, you've also heard me mention that one contract is 100 shares. One contract is 100 shares, right? Well, not always, okay? So yes, for US listed stocks, ETFs, and indexes, one contract is always 100 shares. Very simple. But if you're trading, for example, on the Hong Kong market, which is what I do often as well, it's not always 100 shares. So if you're trading options on Hong Kong stocks, go to this website, hkex.com.hk, and it will show you the contract size for all the different stocks. And it's all different. So for example, if you're trading options on Meituan Tianping, ticker symbol 3690, one contract of options equals to 500 shares. If you're trading on JD.com, ticker symbol 9618, one contract, 500 shares. But if you're trading on China Evergrande, one contract is 2,000 shares. Alibaba, one contract, 500 shares, right? So again, before you trade options on Hong Kong stocks, check this website out, because you may think, oh, it's 100 shares. No, it's 500 shares. Okay? Now, like I said, 95% of all my trades are stocks, ETFs, and indexes. So just 100 shares, really simple. But if you want to explore trading on futures, just note that it's different. For example, if you trade on crude oil, again, what's the ticker symbol for crude oil? /CL. One contract would be 1,000 barrels of oil. Yep. Be careful. If it expires, it may deliver the barrels to your house. Okay. Natural gas would be 10,000 MMBTUs, which is their unit of measure, /NG. Gold, if you're trading gold /GC, one contract would be 100 ounces of gold. So it's all a bit different, right? Like I said, once in a while, I'll trade the E-mini futures, E-mini S&P futures /ES. One contract would be 50 futures. Now, usually the E-mini futures are for people with big accounts, at least 50 to 100 grand account. If not, it's too expensive. So if you've got a small account, like $2,000 account, then it would be more affordable to trade the micro E-mini futures, where one contract would be 5 futures. And these are all currencies, which I don't trade myself. But again, if you're interested to trade currency future options, you can see that for 6E, which is the euros, One contract would be 125,000 euros. For Australian dollar, 6A, one contract 100,000 Aussie dollars, and so on and so forth. It's all there. So let me just show you some of the examples of the different things we can trade options on. And again, the first thing would be to trade options on specific stocks. So for example, you may want to trade options on, say, Bank of America, so BAC, and just click on trade. Again, I'm using the TD Ameritrade Thinkorswim platform, but you can trade with any options broker as well. So again, you can see these are all the expiry dates. And if I open up this one, oh, by the way, so notice the ones in purple are weekly options, which means they expire on the Friday of the week. Whereas the one in black, they are monthly options. They expire on the third Friday of every month. Does it matter which one you choose? It doesn't matter, right? It doesn't matter. Sometimes I choose weeklies, sometimes I choose monthlies. As long as you choose the date which suits your strategy, that's fine, okay? So for example, you can see that for Bank of America, how much would it cost to buy a call option, for example, at the strike price or at the money? So $33 is the current price. If you buy a call option at 33, if I click buy on ask, sell on bid. So I click buy here, you can see it's going to cost me $1.41 per contract. And again, one contract equals to 100 shares, right? So how much would this cost me? It would cost me $141. In fact, if I click this, you can see over here, there we are. My maximum loss, which is the premium that I pay, would be $141. The profit is infinite because when you buy a call, limited risk, unlimited return. So this would be an example of trading options on a specific stock. Or again, you can trade options on the ETF. So ETF would be like SPY, that's an ETF. And again, remember, for stocks, ETFs, and indexes, one contract would always be 100 shares. So you can see for the SPY, the current price is $375. And again, if you were to trade, for example, the 19th February expiration, and if you buy a call option at the money, which is about $375 thereabouts, you buy this call option, it's going to cost you $8.86. So again, times 100, what's the total cost of this contract? $886. So again, if you want to check, click on that. You can see, again, your maximum loss would be the premium that you paid for the call option, which would be about $886. Now, for some of you, it may seem quite expensive, right? It's like almost $1,000 for one trade. But again, later you're going to learn how to construct call spreads, where you can reduce this by half, or you can reduce this by half or 80% by selling another call to finance the first call. All right, so those are more advanced techniques you're going to learn in the subsequent lessons to come. Okay, you can also trade options on the index. So like the S&P 500 index would be the SPX. So this is the index. Okay, and the index right now is 3768. Again, you can't buy shares on the index, but you can trade options on the index. And generally, the contract size is quite big. So only for people with bigger accounts, like $50,000, $100,000 accounts, it will make sense to trade the options on the index. If you've got a smaller account, then trade the options on the index ETF. The contract sizes are smaller. So again, you can see that 3768, if you buy one call here, is going to cost you 7970 times 100. You can see one contract is almost $8,000. Okay, so it's really, really expensive. Not many people can afford almost $8,000 a contract, and you could lose the entire $8,000 if it expires. So it's not feasible unless you got a really big budget. Okay, but like I said, you will learn strategies like the snipebacks, where you're able to trade the SPX with a very small contract size of only $100. The snipebacks is taught in level 2. Okay, so I've showed you stocks, I've showed you ETFs, I've showed you indexes. Next, let me show you the futures. Again, remember, futures are 23 hours. And once in a while, I do trade futures. So the first one would be the S&P 500 E-mini futures. Ticker symbol /ES. So this advantage of trading this, again, is 23 hours a day. You don't have to wait for the market to open. You can trade it anytime over 23 hours. Do understand that futures are a very, very, very advanced and sophisticated tool. Normally only professional traders use. So if you're not familiar with this, please do not trade this until you get more experience, right? But I just want to show you that when you trade options on the futures, the E-mini futures, okay, the multiplier is 50, right? So for example, let's open up this expiry over here. And if you buy a call at the money 3746, if I choose one 3745, that's close enough. So click on that, buy. You can see that the price will be 38.75, correct? So if you buy a call, you'll be 38.75, not times 100. No, times 50. Remember, from the chart I showed you earlier on, for the S&P E-mini futures, one contract will be 50 futures. So sure enough, if you take this times 50, it'll be 1937.5, which is the premium that you pay, which again, is very, very big, normally for people with bigger accounts. So if you've got a smaller account and you say, I want to trade the futures, but it's too expensive, you could trade the micro E-mini futures, which is /MES. So this one is cheaper, right? So this is the, this one, the multiplier is times 5, only times 5. So again, for example, if I were to buy, say this guy, I buy 3745, right? So 6150. So one contract would be 6150 times 5 would be $307. So that's a lot more affordable for people with smaller accounts. Okay, right? Okay, finally, let me show you, for example, if you want to trade on gold futures, right? And this is gold, and you can trade. Again, you get the option chain that comes out as well. So if you go back to that chart, over here you can see that for gold, one contract would be 100 ounces of gold, right? So again, you could, trade whatever expiry date. You could buy a call on gold if you think gold is going to go up. Gold is 1827 right now. If you buy this at the money 1830, that will be $30.90. So you multiply that by, what's the chart again? Multiply that by 100 ounces of gold. There you go. So the maximum loss will be $3,000 and profit infinite, right? Okay, so we're coming towards the end of lesson 1, and I do admit it's been a pretty long lesson because we have to cover a lot of the basics of how options work. But I hope that, again, you've got a pretty clear idea right now. And if you need to, like I said, review the lesson twice, 3 times, 4 times, whatever it takes for you to understand it. And you got any questions, send us an email at support@piranhaprofits.com. Like I mentioned before, when I first learned options 15 years ago, I found it really challenging myself. I was lost. It took me a couple of months before I got it. But once I got it, it became really simple. It's like riding a bicycle, you never forget it. And it changes your investing and trading life forever. And you would never know how you lived without it. Okay? So like I said, don't give up. If you find it confusing at first, review it, and you will understand it. You will. All right, great. So we've just completed lesson 1, and let's see what else we're going to cover in this Iron Shell Level 1 course curriculum. So in lesson 2, you'll be learning how to set up the charts and the trading tools, how to set up the charting platform, which I showed you earlier on very quickly. How do you create a watch list? How do you read and analyze an option chain? How do you analyze the risk to reward graph? How do you use probability analysis? And how do you place and modify your trading orders? How do you enter a trade? How do you exit a trade? All that will be covered in lesson 2. And then we go on to lesson 3. So lesson 3, we begin the strategy section. How do you actually use options to profit, right? So lesson 3 is the simplest way to trade options. Simply buy a call or buy a put. That's it. We call it long calls and long puts. It's the simplest way to trade, but it's the most expensive, and you need the price to move a lot for you to make significant profits. So again, you'll be learning all the entry and exit rules and trade management rules of simply buying long calls and long puts. In lesson 4, you'll be learning how do you generate extra income for your investment portfolio by selling covered calls. So you sell call options that are covered by first owning the stock. And we'll go through again all the rules on how to do that profitably. Yeah. Lesson 5 would be how do you hedge your investment portfolio using protective puts. So once again, in the short term, markets go through corrections, market goes through bear markets for a few weeks, a few months. So how do you generate short-term profits as the market goes down and use the profits to buy more good companies at a lower price? You'll be learning how to do that in this lesson. And how do you use put options like an insurance policy on your portfolio? Lesson 6, one of my favorite approaches, which would be how do you buy stocks of your favorite companies at a discount or even eventually for free. And this is Warren Buffett's favorite strategy. That's right, he uses this the most. We call it selling cash secured puts. And again, all this comes with a lot of case studies, a lot of real life examples. Then in lesson 7 and lesson 8, you'll be learning how to use options for short-term swing trading. So for example, if you want to take a long trade in the market, you think that, okay, the stock's going to go up, I want to take a long trade, you will buy vertical call spreads. Now remember that when you buy a call itself, it's very expensive. It can be really expensive, and it loses value every day. So how do you reduce the cost of buying a call and reduce the effect of theta decay, of the time value being lost? You use what is known as a call spread, also known as a bull call spread, and it looks something like that. All right, so we buy a call and then we sell another call at our profit target, and we sell the call and we use the premium from that call to finance part of the call that we buy. So it's a brilliant strategy. You're going to learn that in lesson 7. Lesson 8, if you're betting on the stock going down, instead of buying a put, you buy a put spread. We call it a bear put spread. Again, that lowers the cost of the trade and reduces the effect of time decay. So lesson 7, lesson 8 will be very useful in your swing trading strategies. Okay, this is also known as a bull call spread, and this is also known as a bear put spread. Then in a bonus lesson, you'll be learning the basics of technical analysis. Now, for those of you who may not have taken my professional stock trading course or my investing course, you may not have an idea how do you read the market trend. Like, is it an uptrend? Is it a downtrend? What's a support level? What are moving averages? So for those of you, this is a bonus lesson to teach you the basics of how do you read the market, to know when to go long, when to go short, when the market is going to sideways, right? So you'll be learning all these techniques, how to identify trends, using support and resistance, moving averages, and using specific indicators and candlestick patterns. So that concludes lesson 1 of the basics of options trading, and I'll see you guys in the next couple of lessons. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.